Hello. In this video, what we're going to discuss is how the interest rate changes as an aggregate demand shock is rippled or propagated through the economy by way of the spending multiplier. If you'll recall, the bottom line is going to be that the interest rate effect is going to dampen the effect on total spending. Now, we're going to do this through an example of an increase in government spending. And the impact of the interest rate has a term attached to it when it's attached to government spending, and we'll get to that in the next slide. But what I wanted to point out was that this interest rate effect on total spending occurs not just for fiscal policy, but for any aggregate demand shock. We're going to do a positive aggregate demand shock. But the interest rate effect also acts on a negative aggregate demand shock in exactly the opposite way. Okay, let's march through it. So let's say we're looking at a positive aggregate demand shock where government spending increases by $200 billion. And in this case, just to do a little something different, we'll assume that the marginal propensity to consume is 0.8. Okay, so we know that what's going to happen is from the spending multiplier, what the spending multiplier tells us is that $200 billion is actually going to be multiplied to find its total impact on total spending. So we know the change in total spending is going to be 1 over 1 minus the marginal propensity to consume. And remember, we call this expression right here, this is our multiplier. It tells us how much that initial shock is going to be multiplied and the value of our initial shock. And remember, this is the value that the initial shock has on spending, which in this case is $200 billion. So the change in total spending is going to be 1 over 1 minus 0.8 times $200 billion, or 1 over 1 minus 0.8, that's 5. So the value of the multiplier is 5 when the marginal propensity to consume is 0.8. So this shock of $200 billion is going to be multiplied 5 times so that the change in total spending, right, the change in total spending is going to be equal to $1,000 billion or $1 trillion. So that's the effect on spending if interest rates don't change. But actually, we know interest rates do change. Okay, so this is an important point to keep in mind, that what this spending multiplier tells us is how much spending would change if interest rates didn't change. Okay, but we've already discussed, we know interest rates will change. And in the case of a positive aggregate demand shock, as is this one, the increase in spending that occurs from the initial value and all the multiple rounds is going to increase the demand for borrowed funds, increase the demand for credit, because as people spend more, some of those things that they buy will be large ticket items, and it'll increase the demand for borrowing. Also, firms may also increase their demand for borrowing as well. So this increased demand for credit is going to push up real interest rates. Now, we don't have a negative aggregate demand shock in our example, but just for thoroughness, if we had a negative aggregate demand shock, then as spending falls, the demand for credit would fall, and interest rates would decline. Okay, but let's continue with our positive aggregate demand shock example, right? So government spending increasing by $200 billion, which would increase total spending by $1 trillion if interest rates did stay the same. So what's going on here is we have a positive aggregate demand shock. And if we had just the initial value of the shock, aggregate demand would increase this amount, $200 billion. But because of the multiplier, actually, aggregate demand is going to increase a lot more. Let's go to aggregate demand 2. Aggregate demand increased by 1,000 trillion because of the multiplier effect. So from aggregate demand to aggregate demand 2, that's the total impact on aggregate demand. That's the total spending change due to the multiplier effect. When interest rates don't change. But here we know what's happening is interest rates are going to be rising. We also know as interest rates go up, investment spending goes down because the cost of borrowing goes up and the opportunity cost of using retained earnings for investment goes up. So firms buy less equipment, machinery, structures. We also know that higher interest rates also decrease some forms of consumption spending. So what this does is this tends to push back aggregate demand some. So, excuse me. So we end up here at aggregate demand 3. That decline right there, we don't have a way without more information of saying how big of a dampening that's going to be. But this is due to the interest rate rise. Okay, so total spending would have increased all the way out to aggregate demand 2 if interest rates were unchanged. But because that increase in spending is going to raise interest rates, then that's going to generate some spending declines, which is going to make the total effect on aggregate demand smaller. The rise in interest rates has dampened the increase in total spending. So total spending is still going up. It's just that that increase is going to be smaller because of the interest rate rise. Okay, so this is the short run. So what we've done in this slide is show the short run impact on aggregate demand. Okay. Let's think about the long run, the short run and the long run impact of expansionary fiscal policy now that we've got all of these elements in place. So let's draw aggregate supply, aggregate demand. We've got potential output. So as usual, we're going to assume that we start off at potential. And so we had this increase in government spending of $200 billion. It's multiplied through the economy, generating all those rounds of additional spending, but also interest rates have gone up, so that the short run effect on aggregate demand 3, this increase from AD to AD3 includes the initial shock, the effect of all those additional rounds of spending, consumption spending, but also the dampening effect of higher interest rates. So we started off here at point A, and in the short run, we move to point B. So this increase in government spending, when we start off at potential, generates a boom, just the jargon, an economic boom, right? We are going above potential output. So as we go above a potential output, now what we want to start to talk about is the transition to the long run. The transition to the long run. And we know this. We know what happens when we have a positive aggregate demand shock that pushes us above potential output because we have tight labor markets. We have labor markets that are tight because we have firms producing above capacity. The goods markets are tight. Production is tight. We're producing above capacity. Price expectations go up. And as price expectations go up, actual prices start to rise. That is, the firms that were keeping their prices stuck because of high menu costs now start to raise their prices, and wages start to rise because of the tight labor markets, and the higher price expectations encourage workers to bargain for higher wages, and firms need to comply because the labor markets are tight. They don't have much of an alternative. And as prices and input costs, as input costs go up, firms are only willing to produce more at higher prices, and the economy returns to potential output here at point C. Now, I want to make an important point here. Remember, with monetary policy, we got here at point C, and we said, all right, look, monetary policy is neutral. Nothing changed besides we got higher prices. In general, a positive aggregate demand shock, of which more government spending is one, is not going to be totally neutral. And that's because we have higher interest rates. So remember, output is a combination of C and I and G and net exports. So in the end, when we're at C, when we get to C, the change in output is zero. But we have higher government spending, and we also have lower investment spending because of higher interest rates. And those higher interest rates are going to make the exchange rate appreciate. So net exports are going to be lower, and there'll be some lower consumption spending also because of the higher interest rates. So even though when we get to point C at the long run, after all prices and price expectations have adjusted, an aggregate demand shock that is not a monetary policy shock is in general not neutral. It's not neutral because we end up with a higher interest rate, an appreciated exchange rate, and because of those things, we have lower investment, lower net exports, and maybe consumption spending that's a little bit lower. What's happening here is higher government spending has crowded out private investment spending and other forms of spending as well. Okay? I'm going to write it up here. I've run out of room. Remember, I said in the beginning that there's going to be a special term for the effect of interest rates on other kinds of spending when we're talking about fiscal policy. Well, this is it. Fiscal policy, because of generating higher interest rates, has the ability to crowd out private investment in consumption spending, lower net exports, because of additional government spending. Okay, that's it for now. And as always, thanks and enjoy.